Hello, it's Cameron here. Had slightly less time I thought than I would to make videos after my exams, but still thought I'd find a bit of time in, especially since quite a bit's happened now ever since the inflation figures have been released, and I wanted to make another video sort of ahead of the Fed meeting tomorrow. So yeah, let's get into it. So in a previous video, I sort of mentioned how the market, or I believe the market, had priced in a 50 basis points rise for June and July. However, since the inflation figures came out for May of 8.6%, that was a lot higher than what most people thought. So as a result, lots of people are speculating a 75 basis points rise on Wednesday. I think it will come on Wednesday or tomorrow, but if it doesn't come then, I do definitely believe that it will come the month after. I'm really unsure about September still, to be honest with you, because I normally thought I was under the impression that they'd try not to change rates because they wanted to stay, because obviously the midterms are then, so I thought they'd try and stay out of that a bit, but I think they're not going to care about that at this point. I think they're just going to think like inflation's getting out of control, we need to sort something out. But yeah, I think this article kind of illustrates it quite well. Um, Basically, other economists also believe that 75 basis point rise is coming, even a 1% basis point rise is even being called out as being more likely than a 25 basis point rise. But yeah, anyway, so just to sort of towards my friend who watches these, I just wanted to say, so the idea is that the reason why we're seeing the recent turmoil in the stocks over the last couple of days, because they think a basis point rise is going to happen, is because if the Fed increases the interest rate, it means it's more expensive for firms to borrow. Basically, they have less access to capital, less access to grow, which means that stocks generally just hurt. Their ability to be companies is basically hindered. Um, so yeah, that's why stocks sort of have a bit of a turmoil when interest rates are higher. There are exceptions to that, which is financial stock, which I'm going to sort of go into a bit later in the video. But yeah, that's generally the reason why. So just wanted to touch on some historical data about the S&P 500 just before I quickly move on to some other stocks. So this is another article basically about the impacts of what the S&P 500 does after inflationary peaks in the last 40 in the last couple of years. So the main point here, I'll save the reading, is basically it gains 13.2% in the 12 months following the inflation peak. So I thought the inflationary peak was 2 months ago. I think it was again high 8 point something percent. But again, it's quite difficult to know. I mean, that's why the inflationary figures the other day were such a big surprise. Um, but again, a 13.2% rise after inflation peaks in inflation. The other thing, I don't really go normally for these sort of gotcha headlines, but I think he does raise a really, really good point, which is surrounding the S&P's forward earnings. Yeah, so so he's noticed the S&P 500 is now trading roughly forward price ratio of price to earnings ratio of 17, and if you include tech stocks, it's now actually at 13, and over the years the average is actually 18.6, and so generally the idea he's saying is that they're actually trading at a deficit, which is another thing looking to the future again. I am not really sure. I think there's a lot more things to take into account, and I don't think it can really just be summarized in price to forward earnings ratio. But yeah, moving onwards. So this is sort of really what I wanted to talk about in the bulk of the video, which was more about the financial stocks. So Goldman Sachs and Wells Fargo are now trading well below book value. I'm surprised I didn't mention it in the title, but Citi is trading like far, far below both of these. But generally the idea is, so they're trading below book value, which basically means if they sold off all their assets, that would be worth more than their market cap. So you can see that here. So it's now trading below its first quarter book value of 293 a share, because it's now trading at 287.56. So yeah, and that's similar to Wells Fargo, which I think was somewhere else. I mean, I originally, because I generally invest based off PE ratios. So like I actually invested initially when it was around 400, which is really just hitting the nail on the head. but since then it's come down quite a lot, obviously. And I think it's a strong buy even now. I think I sold it off around February. Um, but yeah, definitely. But the one that I wanted to talk about most is actually City, which I know that Berkshire Hathaway just invested quite a bit into, um, which is basically because their book their ratio is that their book value is half is basically 50%. I think it's 47 compared to their book value of $92. Um, yeah, yeah, I know that's Wells Fargo, but yeah, yes, yeah, yeah. So those are just some financial stocks. I especially think sort of investing in those more in the long run will help as well, because I think I've mentioned it quite a bit previously. So recession stocks uh, are really good looking forward to the next year, because obviously so many banks have come out predicting recessions in by the end of 2023. Well, that will come by the end of 2022. I'm not sure. Um, but the reason why financial stocks do so well in recessions is because when interest rates are higher, banks have the ability to charge more, basically. So financial institutions tend to do really, really well, which is why I was sort of investing in things like Goldman, um, as well as other things like healthcare and utilities, which tend to be quite good in recessions. Um, but yeah, sort of finish off looking at a few of the indices. So the VIX again has spiked up massively over the last couple of days, and generally, from what I've heard, it's when it's above 30, it's sort of a strong buy, because of fear. So the VIX is like a fear index, almost sees how much fear there is in the market. S&P as well, just been absolutely crushed over the last couple of days, 9.7%. And then similar to the Nasdaq, 10.65. I think it's down. Yeah, year to date it's down 31%, which is just horrible. But yeah, so that's just a bit of a market update with what I believe is going on in the market tomorrow. I'm going to I'll make another one probably a few days after the Fed comes out its uh, its decision on the interest rate. But yeah, thank you very much for watching, and see you all later.